Buying a home, why it might be a bad investment for financial freedom. When we think of financial freedom, we often imagine a life without debt, with a passive income stream that allows us to live the way we want. Yet one of the steps that many consider a finish line toward this freedom, buying a home, may actually be taking us further from our goal. I'm not saying that buying a home is always wrong, but it's important to understand why it might not be the best investment for achieving financial freedom. The house, an asset that does not generate income. One of the fundamental principles of financial freedom is building a portfolio of assets that generate passive income. Robert Kiyosaki, in his book Rich Dad, Poor Dad, distinguishes between assets and liabilities. An asset puts money in your pocket, a liability takes it away. The house you live in most cases, is a liability. It does not generate income, rather, it requires ongoing costs, mortgage, maintenance, taxes, insurance, bills. Let's take a practical example. Imagine buying a $300,000 house with a 3% mortgage over 30 years. In the end, you would have paid about $455,000, principal and interest. Add to that the maintenance costs, taxes and insurance. Over 30 years, you would have spent almost $550,000 on an asset that, if you don't sell it, has generated absolutely nothing for you. Missed opportunities, the opportunity cost of capital. When you buy a house, a large part of your capital remains locked in the property. This money could be invested in more profitable assets. Let's take the same example of $300,000. If instead of buying a house, you invested that money in a stock portfolio with an average annual return of 7%, historically, the stock market has returned about 7 to 10% annually. In 30 years you would have accumulated over $2.2 million. Even if you don't have $300,000 to invest, think about the difference between paying a mortgage and investing monthly. Let's say your mortgage is $1,000 a month. If instead of paying the mortgage, you invested that $1,000 a month in an index fund with a 7% return, after 30 years you would have about $1.2 million. That's the power of compound interest, which Tony Robbins also talks about in his book Money, Master the Game. The house is not liquid. Another problem with the house as an investment is the lack of liquidity. If you need money, you can't sell a piece of your living room. And selling a house can take months, if not years, especially in a stagnant real estate market. This makes you less financially flexible. In contrast, investments like stocks, bonds or ETFs can be liquidated in a matter of days, giving you immediate access to capital. The home ownership dream trap. Society has taught us that buying a home is a mandatory goal, a symbol of stability and success. But is that really the case? In the book The Millionaire Next Door, Thomas J. Stanley and William D. Danko show how many millionaires live in modest homes and prefer to invest their money in income-generating activities. Homeownership, especially if large and expensive, can become a trap that forces you to work harder to maintain a lifestyle that, in reality, does not bring you closer to financial freedom. Renting, an underrated alternative. Renting a home is not throwing money away, as many believe. It is a fixed cost that allows you to maintain flexibility and invest the rest of your capital. Let's take the example of a family that pays $1,000 in rent per month. If instead of buying a home, they invested the difference between the rent and the cost of a mortgage, say $500 per month, in a stock portfolio, after 30 years they would have accumulated hundreds of thousands of dollars. Additionally, renting allows you to easily relocate to pursue career or life opportunities, without the burden of having to sell a property. When does buying a house make sense? I'm not saying that buying a house is always wrong. It makes sense if, 1. You've already achieved financial freedom and want a house as a place to live, not as an investment. 2. You have a clear plan, for example, You buy a multi-family home, live in one part and rent out the others, generating income. 3. The real estate market is extremely favorable and you expect the value of the house to appreciate significantly. But what if you use that house to generate income? This is where options like Airbnb, long-term rentals or resale come into play. Let's look at them in detail. 1. Long-term rental, a steady cash flow. If you decide to rent out your home, you can turn it into an income-generating asset. Let's say your $300,000 home can be rented for $1,200 per month. After paying expenses, maintenance, taxes, insurance, you could net about $800 per month. This would give you an annual return of 3.2%, $800 by 12, $300,000, which isn't bad, but it's lower than historical stock market returns, 7 to 10%. However, there are risks. Vacancy. If you can't find a tenant, you'll have to cover the costs yourself. Tenant issues, damage to the property, late payments, etc. Local real estate market. If demand for rentals drops, you may have to reduce the price. 2. Airbnb, higher returns, but more work. Airbnb can be much more profitable than a traditional rental, especially in tourist cities or areas with high demand. Let's say your home can be rented on Airbnb for $100 per night, with an average occupancy of 70%. This would give you a revenue of about $2,100 per month. After expenses, cleaning, maintenance, taxes, you could have a net of $1,500 per month, or a 6% annual return, $1,500 by 12, $300,000. Cons. Management intensive. You have to take care of bookings, cleaning, communicating with guests. Regulation. Many cities are introducing restrictions on short-term rentals. Seasonality. Income can vary greatly depending on the time of year. 3. Reselling, the appreciation game. Another way to make money on a house is to resell it at a higher price. Let's say your $300,000 house appreciates 3% per year, the historical average in many areas. After 10 years, it would be worth about $403,000, a gain of $103,000. If you add in the costs of buying and selling, notary, agency, taxes, the net gain could be about $70,000. But beware, appreciation is not guaranteed. The real estate market can be volatile. Selling costs, commissions and taxes can eat away at a large portion of your earnings. Liquidity. Selling a home can take months, if not years. 4. Multifamily housing. Live in one part and rent the other. One interesting option is to buy a multifamily home, for example, a duplex or a house with a separate unit. You can live in one part and rent the other, thus covering part of the mortgage. Let's say you buy a $400,000 house with 2 units. You live in one and rent the other for $1,200 a month. If the mortgage is $1,500 a month, you only pay $300 out of pocket, with the tenant covering the rest. This allows you to build equity in the home without putting too much of a strain on your cash flow. Conclusion: a house can be an investment, but it is not the only way. Buying a house can be a good investment if you use it to generate income, rental, Airbnb, resale, or if you live in an area with strong appreciation potential. However, it is essential to evaluate the costs, risks and missed opportunities. Financial freedom is not built only with bricks and mortar, but with a diversified portfolio of assets that generate passive income. If you want to learn more, I recommend you read Rich Dad, Poor Dad by Robert Kiyosaki. The Millionaire Next Door by Thomas J. Stanley and William D. Danko. Psychology of Money by Morgan Housel. Money, Master the Game by Tony Robbins.